Neelkanth, it's great to have you on the show today. You are no stranger to bear markets. Having seen so many over the decades, how bad do you think is this one going to get? I mean, by when do you think we'll start talking about the end of this one?
Udayan, as always, absolutely a pleasure talking to you. Thank you for having me on the show. We have seen the PE correction. As you know, the markets are driven by price to earnings and earnings. If you divide the market performance into how much have forward earnings changed and how much have price to earnings changed. So I think the price to earnings change in this cycle is more or less done. We could see another decline, and that's something I'll comment on briefly later. But I think the risk now, and I'm talking here at an APAC level, at a global level, is now the earnings changes, right? So as the global growth expectations now are steadily revised down, so everyone expects a growth downgrade. How severe that is as yet unknown. But the next leg for markets globally in Asia Pacific, and therefore by linkage to India, will be how much do we see the earnings fall by. And there I think the prospects don't look that good, in particular in sectors like IT and materials. Now, having said that, if you remember the 2000-2001 recession or the market downturn started off as a deflation of a dot-com bubble. But then 9/11 happened and we saw further downside of the market. Similarly, in 2007-8, it was supposed to be the US real estate market correcting, but then Lehman went under and we saw a much bigger problem. So if it remains just a wind down of the fiscal and monetary stimulus, which turned out to be excessive in the US, and adjustment to the higher costs of energy because of the Russia-Ukraine conflict, then it should be fairly orderly. And in my sense, in my understanding, I think 6 to 9 months should suffice to get the adjustment going. But if this weakness in the economy exposes other problem areas in the global economy, then we could be in here for a longer time.
The feeling in the market from people one talks to, Neelkanth, though, is that this is a global problem. India is actually not in a bad place. Our macros are fine and we should actually get off fairly light compared to the rest of the world. Do you agree with that hypothesis? And can you recount or recall instances in the past where the world, or the Western world, the US and Europe, have been in a bear market, but India has been in a bull market?
Yes, I think that can happen, though the probability of that happening at this stage would be low. To give you perspective, see, if you think about the Indian market here and the global market here, and this is the price to earnings premium, and think about an elastic band between the two, right? It is possible that, if we started here and the global market is falling off and this elastic is getting stretched, India can hold up, right? But beyond a point, it is very hard for the elastic band to stretch a lot, in the sense that our equity markets are totally open, in the sense that investors can come in and go out. Our capital account is totally open on that front. And therefore, global equity markets in many ways are deeply interconnected. What we also have to remember is that India is not yet an asset class, in the sense that a very large part of the equity capital that comes into our markets is through the emerging markets and Asia Pacific indices. So people invest in emerging markets. If the emerging markets asset class is not doing that well, then we will have problems as well. If the Asia Pacific markets are going to see a very significant impact of the downside risk on global goods demand, then I think the Indian markets will get affected as well. So I do think that we have to be wary of that. And remember that despite the decline that we have seen in our market so far, on a rolling 12 months basis, in dollar terms, we have outperformed the world by more than 20% in the last 12 months. So, so a lot of the resilience of the Indian economy and the fact that we didn't benefit that much from the global goods demand surge created by the US stimulus is something that I think the market may already be pricing in. So if more downside, if earnings downgrades in Asia, if second order risks in Asia pull down Asian markets more, then I think there is a risk that we get downgraded even more. We also see some downside risk. Having said that, because of the resilience of the Indian economy to what I think is going to be a problem for the world economy in the next 12 months, the forward earnings risk. So basically, if you assume that we did nothing for the next 6 months or 9 months, right? So to till end of FY23, the Nifty stayed at 15,500 or 16,000. On FY24 EPS, which will be the 1 year forward in March 23, we would be trading at sub 16 times forward earnings, and which is, I think, a fairly reasonable multiple to have, given that it was the low end of the range seen between 2015 and 2019. So some amount of time correction should get us to a place where the earnings growth after that will drive upside to our market. I think right now our PE premiums to the world and to emerging markets are still very high. So if global markets come under stress, I think our markets won't be immune.
Neelkanth, what do you think we'll see when it comes to the demand, this whole dynamic play out and its resulting impact on the financial landscape? We're watching out next policy now. It's still a while away. In the middle, in the next 2-3 months, we may or may not see further surprises from the Fed. So we're not quite sure what to expect, but if we assume further tightening, how do you see this reflecting when it comes to the financials, and whether or not they're likely to see the benefit of a changing rate scenario, or whether we'll still see certain challenges?
Right. So, see, the first thing is that if you're tracking nominal GDP,
yeah,
right. So when you're setting a monetary policy, looking at sufficiency of money, you need to look at nominal GDP. The nominal GDP in FY23 is most likely going to be within 3-4% of the pre-pandemic path. I'm not talking pre-pandemic level, I'm talking pre-pandemic path. So some normalization of monetary policy is something that was inevitable. If the economy is doing well, there's no reason for the MPC to say super accommodative. And therefore, 5.15, let's take another 25 basis points on that, because remember that before we went to COVID, the economy was actually decelerating. 5.4, 5.5 type of policy rate is just a reflection of the fact that the economy is now starting to normalize, right? What happens beyond that? Do we go to 6, 6.5? And my sense is that the global demand situation is weakening so rapidly, and especially in sectors like tech, where I think the new order flow is starting to look very weak, and order cancellations are starting. Yeah. And so as that slows down the other economies, remember that the increase in exports from CY19 to CY21 in many of the Asian economies was 4 to 14% of their GDP. So the spillover of goods demand from the US and the excessive inventory building that the whole supply chain was doing is something that had boosted GDP a lot. And as those things start to correct, I think the necessity to keep raising rates may not be felt by the time we are in, say, October or December. Now, having said that, so what does this mean for financials? And I think that just the normalization, remember that credit growth is now at 13%. If back in July, August last year, when we started saying that it would reach these levels, people were wondering how can it do that, right? Because how will the GDP growth be sufficient? And our point was that as the GDP starts to normalize or come to the pre-pandemic path, I think the necessity of building inventory, so working capital is a very big source of credit demand, And just normalization of inventory levels in the economy will, I think, create credit demand, and that should be good for banks, for financial sector in general. And remember that the biggest fear in a down cycle is always for credit quality, right? So the PPOP, the pre-provision operating profits for the financial system is reasonably steady in India, right? It could move between 10 to 15%. But the big volatility comes from the non-performing assets. And so far, the trading template that is being used by investors is still that if there is a growth downgrade, let me sort of be cautious on the banks. And we think that given that we are just coming out, we were starting to come out of it in 2019-20, but then we had COVID. So the banks are really well capitalized. I think the risk of significant credit quality issues emerging in India, at least, is quite low, and financials continues to be an overweight position for us.